Is inflation finally coming down, or are we in for some more pain? Here's what Cathy Wood had to say about it in her latest In the Know video. Link in the pinned comments below.
You can see here, this is a chart that we've presented regularly because we wanted to track how inflation, how correlated it is to money supply growth. So here you can see M2 money supply growth in the purple line, and it had a burst during COVID as the Fed was trying to make sure we did not go into a depression and tried to provide liquidity to the economy. Hit 27% and has been decelerating ever since. It descended into negative territory in 2022. This chart has been moved ahead because money supply leads inflation. And so you can see the green line, which is the CPI on a year-over-year basis, has paused in here. It's been kind of stuck in the 3 to 3.5% range. And of course, the markets, certainly this year, have been very upset by that because the Fed is saying, hey, unless we see 2% inflation, we're not going to cut interest rates. Now, what we believe has happened here is companies are losing momentum when it comes to unit growth or volume growth. And they've tried to offset that, especially the impact on margins, by trying to raise prices. And what we're learning from earnings season is they're not getting away with it. And you'll also notice, maybe, that gas prices have started to come down again because oil prices have cracked. We believe that inflation is going to turn into deflation. In other words, prices will not be rising on a year-over-year basis. They're high and they are still rising. Consumers on strike. Monetary policy, we believe, is still restrictive. And we think prices are going to crack. And that means they'll go below zero cyclically. Autos are in recession-like conditions. Commercial real estate, office, and now even more, multifamily, which is much broader based in what we believe is a recession. We think consumption is entering a recession. Now, during recessions, consumption does not fall apart unless we're in an 08-09 period. But it has been slowing down fairly dramatically here. And we believe we're moving towards a flattish consumption environment, which is very weak. And we do believe that is why pricing is going to come down. I've been saying that the Fed is going to have to ease. And so last year, we had a great year because we got a whiff that the Fed is going to ease. It stopped raising rates. That's good. But it has not given the market any oxygen this year. Innovation-based strategies have been hit this year, hit pretty hard, even though the market is up. Why is the market up? It's all crowding into a few very cash-rich stocks. But right now, the crowding into a few stocks is, we think, being caused by risk aversion until the Fed eases. And we do think that is going to be the case.
And if you think she was just kidding or just plain wrong, here's the recent Jobless Claims and Producer Price Index, or PPI report, from CNBC this past Thursday.
Rick Santelli is standing by at the CME. Rick?
Yes, initial jobless claims for the week of June 8th, 242,000. That's a big pop. 242,000. We're expecting 225,000. That's the highest level since August of 23, since the second week of August of 23. We popped above 1.8 million on continuing claims. 1,820,000. 1,820,000 takes us all the way to November of 21. That is really a big jump. Now, let's look at the PPI data. Wholesale inflation for May, expected on the headline to be up 0.1, is down 0.2. Down 0.2. It is definitely in the right direction if you're looking for less inflation. If we look at ex-food and energy, unchanged, much lower than expectations. And in the rearview mirror, we were 0.5%. Zero is the lightest. And once again, it was minus 0.1 in March of this year. So it's a big improvement based on expectations. Now let's look at the year-over-year numbers, shall we? And I think sometimes these are the most important. 2.2% year-over-year headline. We're expecting a number at 2.5%. Let's food and energy, take those out. 2.3% on a year-over-year basis. 2.4 last month. So 2.3. That drop is nice.
Jobs are softening, consumer demand is softening, and prices are starting to soften. Look, here's the problem. People, and I'm including very smart people, are usually very slow to recognize and accept change. Many of us, and this doesn't include me, as you'll know if you've been watching my videos, feel that inflation is here to stay and prices won't relent anytime soon. But as an investor, you need to be smarter than that. I, along with others like Cathy Wood, have been beating the drum that inflation is going to start moderating, and in fact, there's a bigger risk of deflation coming soon. Why does any of this matter to you as an investor? Large money managers tend to be value-based investors, meaning they take some derivative of earnings and divide it by the risk-free rate to come up with a fair value for a company. When interest rates are high, like they are now, the calculated value of companies comes down. But worse than this, the cost of capital goes up, which puts smaller companies and large debt-laden companies at higher risk. This in turn causes these large money managers to move away from the more risky small and large cap investments into larger cap companies with low debt levels. So what do you think will happen when the Fed finally starts to lower interest rates in response to falling inflation? Well, it depends. If the Fed waits too long to start lowering rates and the economy goes into a bad recession, then the equity markets will most likely drop well before they start moving higher. If, on the other hand, the Fed starts lowering rates and the economy has a soft landing, then it's highly likely the equity markets will respond by moving higher. As investors pour into the beaten-up smaller and innovative companies, these companies will move higher in a dramatic way and outperform the general markets in a big way. So should you be worried about the performance of the stock market because of persistent inflation? The early investors who recognize that inflation is and will continue to come down will benefit from this knowledge, while those who are afraid and wait too long will miss the coming opportunity. Do you think inflation will persist for longer than some of us think? Or will the markets be caught off guard by rapidly falling prices and inflation? Please share your thoughts in the comments below. With all that being said, let's take a look at the current health of the stock, bond, gold, and crypto markets. If we look at how equities performed over the past week, the past 5 days, you can see we have a dichotomy here. You can see we had a very nice rally going right into the middle of Wednesday, and then on Thursday and Friday, the NASDAQ and the S&P moved higher, but ARK Invest and small caps moved lower. So this is quite a set of mixed signals here. And what's also interesting is the Dow finished just about dead last. So are investors acting a little schizophrenic? They're putting money in the NASDAQ and the S&P 500, so large cap stocks. They're staying away. In fact, they're selling innovative stocks and small cap stocks, but they were also selling the safer Dow stocks. That kind of seems crazy to me. What about over the past month? Well, you can see we kind of bottomed out here, and you can see how the NASDAQ and the S&P have moved higher, while the Dow, ARK Innovation, and small caps have all just been floundering. What about year to date? Well, if we look at year to date, a very similar picture. NASDAQ and S&P 500 leading the way higher. And by the way, this plays into my video from last week where I talked about the gains in the market coming from a very small handful of large cap companies. And then if you look at the Dow is down here, small caps down here, and ARK Invest way down here. And if we look back over the last year, you can see how this behavior is currently presenting itself. NASDAQ on the top, S&P second, Dow third, small caps fourth, and ARK Innovation down here at the bottom. So how does all of this show up in the current bottom dynamics? Well, interesting here. We had a very nice attempt at a bottom confirmation. This blue line was moving higher, kind of pulled back and then moved up even higher. It never got high enough, though. You really want it to be up here at 100% like it was back here. But back here, the confidence level was down here below 60, barely ticked above 60 right here, while this was up at 100. So that's not a bottom confirmation. We had then a bottom forming indicator come up, but again, it never got high enough to really be a bottom. And look, we haven't been in a bad place. The markets have in general been moving higher. Now where are we? Well, the bottom confirmation signal is falling, but so is the confidence level falling. That kind of indicates to me that the markets are mixed up and they don't quite know where they're going. And what if we look at risk versus opportunity? Well, you're not going to get any help here. I can tell you that. You can see that the risk level, this red line, is not only high, but it's moving higher. It's up here approaching 80. Now, this is very much a lagging indicator, and I think the reason this is happening has something to do with the fact that risk acceleration, this yellow line, was moving higher back here like crazy. But again, this is a lagging indicator, so I think this is starting to show up here. But now what's been happening with risk acceleration? Well, you can see since back here, it's been declining overall. And even recently, it really dropped back here. Now it ticked up a little bit here, maybe at least on Friday, maybe Thursday and Friday. But this is below 60. I don't really get concerned with this until it's above 60. And then what about the opportunity level? Well, this blue line, the opportunity level, is again a lagging indicator, but you can see that it's been moving higher and higher. You want this to be moving higher, and you want it to be at a high level. Well, it's above 60, which is good. That's great. But if you look at opportunity acceleration has been moving higher since way back here. In fact, it started moving higher right back here even before we actually hit the bottom here. So this is a very good indicator. Even though it kind of pulled back here, I like the fact that this is above 60, and in general, the trend is higher. And what about equity versus safety? Well, if we take a look at equity versus safety, you can see that the NASDAQ 100, as you saw in those performance graphs, has been sitting right up here in first place. This is great. Now, what about small caps? You can see that small caps have not been performing well, as we saw in the performance graphs that I showed earlier. Now, it was giving me concern that cash was sitting up here in the third position, but I like the fact that cash has fallen back to the fifth position. I'd like to see it continue declining and going lower as we move forward. And if you overlay the S&P 500 and the Dow on this, it kind of matches what we saw in the weekly and monthly performance numbers. You can see that the Dow and the small caps are down here at the bottom. SPY is up here behind the NASDAQ 100. And you can see that Treasuries have been performing well. And you'll see that when we look at the weekly Treasury performance numbers. But I like this look with the NASDAQ 100 up here. Now, I'd like to see small caps moving up here in the ranks, but that's not going to happen until the market's convinced that the Fed is going to start lowering rates. And what if we look at safety assets? Well, if you look at safety assets, I like the fact that gold is down here in 10th place. And as I mentioned earlier, I like the fact that cash has pulled back here to 5th place. I'd like to see it continue moving lower. And I like the fact that we're going from short duration to intermediate to 20-year treasuries to very long duration treasuries. So this is a healthy treasury risk appetite and should bode well for treasuries going forward. What about the buying and selling pressure? Well, you can see this is really a mixed picture here, as I mentioned earlier. Look at this. The Dow's pulling back while the S&P 500 and the NASDAQ are moving higher. Small caps have been going down to nowhere. You can see this is a very mixed picture just in terms of price action. But if we look at the buying and selling pressure, you have a very similar picture. You've got the selling pressure absolutely shooting through the roof for the Dow, while for the S&P 500, the buying pressure is well above the selling pressure, and the selling pressure is in fact moving lower. Same thing for the NASDAQ 100. Selling pressure declining, buying pressure increasing, price increasing. And for small caps, the buying and selling pressure, now the selling pressure is declining here. If you look at this, it's kind of moving lower as the price is moving lower. That is a divergence and tells me that these are poised to turn around and start moving higher. And if we look at ARK Innovation, again, a very choppy non-healthy picture. Is that even a word? Non-healthy? Anyway, this doesn't look good. You can see that the price has been declining, and you can see that more recently, the last couple of days, the selling pressure is increasing while the buying pressure is decreasing. Now, I like the fact that overall the buying pressure has been moving higher and is currently above the selling pressure while the price has been moving higher. So hopefully, kind of like small caps, this bodes well for ARK going forward. But there is no divergence here. You can see that the selling pressure has been declining, the buying pressure has been increasing, and the price has been increasing. Now let's take a look at sector rankings, because these give you an interesting picture across all kinds of sectors in the marketplace. And as you know, I don't spend a lot of time on the rankings because these are very much a picture in the rearview mirror, how things looked. Last week they were here. Now you can see that cash moved up, but this is, again, looking in the rearview mirror. And as we saw in equity versus safety, cash is actually moving down in the rankings. But let's move ahead to sector rank acceleration, because these move more quickly and give you more of a real-time picture of what's going on. Now you're going to look at this and say, well, last week cash was here, and this week it's way up here. What the heck, Calvin? Well, equity versus safety and sector rank acceleration, while they use the same metric, they use different time frames. So they give you a slightly, and look, there's not as many things in equity versus safety. So there's a lot of things here that can push lower and drive cash up. So you're going to get a different look here. But let's take a look at the overlays. So if I put the overlays on here, what is looking good? Well, clean energy moved up a tick. That's good. Technology, semiconductors moved up a couple of ticks. That's great. The NASDAQ 100 moved higher in the rankings. Technology, XLK, moved higher in the rankings. I like the fact that consumer staples has pulled way back, while consumer discretionary has moved higher. The Dow actually moved higher in the rankings, even though the price action has been lower. And then we have emerging companies here, the QQQJ, which is the NASDAQ smaller companies, moved quite a bit up in the rankings here. And then what isn't looking so good? Well, if we look at this, as I mentioned, cash moved higher. That's not good. ARK Innovation moved down in the rankings. That's not good. And gold has pushed up here, which is not good. Now, small caps moved down just one tick. So not a big move, but not the direction you want to see them go. So if you look at this, treasuries moving up can be interpreted as a bad sign because there's a flight to safety. So we'll have to keep an eye on this and see how this looks going forward. But this could also be a good thing because treasuries are responding to the thought that maybe the Fed will lower interest rates, which will be good for equities. So kind of a mixed bag here. I put these as red arrows, but you know what? They could just as easily be green. And speaking of treasuries, how have they looked this past week? Well, unlike equities, they're not as mixed up. You can see that long duration treasuries went up like crazy, finished up almost 6% for the week. That's insane for a safe haven asset. 20-year bonds finished up 4% for the week, followed by what I call long to intermediates, 7 to 10 year, followed by intermediates, and then followed by short duration. Of course, that date's going to get in the way. But anyway, so that's a very, very healthy look for treasuries. What about over the last month? Well, you can see how they bottomed out here and have been on a very nice rally since that time. And if we look year to date, we're still not out of the woods, although things are moving very rapidly in the right direction. And then if we look back over the past year, you can see we're still below water here, about almost 12% under for the longest duration treasuries. But again, moving in the right direction very quickly. And how does all of that show up in the buying and selling pressure for treasuries? Well, you can see the price action on short duration treasuries has been very nice, moving higher. And you can see that the buying pressure is well above the selling pressure. What about intermediate treasuries? Again, price action moving higher, a little more volatile. But in this case, the buying pressure was very nice here, pulled back, selling pressure was above. And now it's a little hard to see in this graph, but the buying pressure is just above the selling pressure here. And then if we look at 7 to 10-year treasuries, again, a very nice price movement higher. And you can see that the buying pressure is also moving higher and is above the selling pressure. Same picture for long bonds. You can see the price moving higher and the buying pressure well above the selling pressure and moving higher. This looks very good for treasuries going forward. And this might be in response to the idea that the Fed's going to have to start thinking about lowering rates sooner rather than later. And what about that inverted yield curve? Well, it got a little bit worse this past week, but it got worse for a good reason, because longer duration yields came down. You can see last month they were up here, and this month they're here, versus a year ago when they were way down here. So as these longer duration yields come down, that's going to cause this yield curve to get even more inverted. So we're almost 49 basis points inverted, or 0.49% inverted. And nothing's going to happen until the Fed lowers the rates at this end, which is where they control things. And you can see how the rates have come down from where they were a year ago, this top light blue line, to where they are now, this dark blue line. So once the Fed starts lowering, these are going to come down drastically, and it will cause this to not be inverted anymore. And what about the Fed rate monitoring tool? Well, interesting that the probability of the Fed keeping rates the same has come down. This was up in the plus 90% range just a few days ago or last week. Now it's come down to 87.6%. And the idea that the Fed could possibly lower rates in July is moving higher. This is good. Now, if we go out to September, there's much less than a 50%, in fact, barely a 30% likelihood that rates will be where they are right now. And there's a pretty good likelihood that the Fed will lower rates by at least 0.25% come September. And then if we look out in November, it's got to be a landslide. Yeah, it just gets better. So this is starting to look really good. Now we have to wait 6 weeks till July to see what actually happens. But I got to tell you, if the CPI and PPI numbers keep coming in and the economy starts looking softer, this number is going to come way down and this number is going to come way up. And what about gold? Well, if we take a look at gold, interesting. You have a declining price in gold and you have declining selling pressure. And it's a little hard to see here. Let me see if I can draw a line on this. So what do we have with gold? Well, if I draw a line through this, we've kind of got a declining price here. But we also have a divergence. We have declining selling pressure here, if I kind of draw along the peaks. And if we look at the buying pressure, it's not as obvious because it's floundering a little bit, but there is a slight increase in the buying pressure. So this combined with this and this is a divergence. That tells me that it's likely, and I'm not saying that just because gold was moving higher here. I think it's likely that gold will go higher next week if this continues. Okay, and what about Bitcoin? Well, Bitcoin has been kind of tried to rally here, and as you can see, it's not doing well. It's been failing lately, and the selling pressure has been moving higher. So doesn't look like a great scenario here. I don't see a divergence that would cause me to believe this is going to turn around and go higher anytime soon. As you can see from the price movements and metrics in the buying and selling pressure charts for equities, the markets are still avoiding small cap and innovative companies in favor of larger cap and especially AI exposed companies. If you want to see my discussion on that issue, click on the link below to watch my video from last week. If there's one thing to take away from my market reviews over the past several weeks, it's that the equity and bond markets have both been moving higher, as you can see here and you can see here. But no one has a crystal ball. This is why I caution you to be an investor rather than a trader who tries to time the markets. Investments and investing aren't that complicated if you know how to allocate your portfolio without destroying your returns and getting little to no protection from downside risks. As an investor, you need to take the long view and allocate according to your risk tolerance rather than fretting about what's currently happening in the world or what everybody else is doing that you read about in the media with their portfolios. If you want to be a better investor, I discuss how to allocate your portfolios in 2 key videos linked in the pinned comments below, titled The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, and The Ideal Portfolio Using Individual Equities. Again, link in the pinned comments. Until next week, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
Stay up all night, gotta work now. Make up my mind and it turns around. Say that I'm fine till I burn out. Thinking this money sounded so nice. Ambush here in the strobe lights. Pay anything for the high price. This life feels like the sunny water.